Good night, everyone. Welcome to another episode of Wife Her Live. I am the founder of Wife Her Ministries, Zemi Stewart, and Wife Her essentially stands for Wife Healed, Empowered, Restored. We are a community that seeks to help women become her, and that her, like I said, is healed, empowered, restored. And every month we have a focus of the month. The focus of this month happens to be finances, personal finances. Last week, on the Sunday before last Sunday, we would have had a session on saving, and today is all about investing with a little recap about what we would have covered in last session. So I'm really excited about this segment. And before I bring on our speaker, I'm just going to read her bio. So we are honored tonight to have with us Tiffany Smith Cartwright, and she is an investment manager at CFAL, Colina Financial Advisors Limited. She is responsible for the management of CFAL's discretionary and advisory accounts, including mutual funds, pension plans, companies, and individuals. She graduated from Temple University, where she obtained a BBA in finance, summa cum laude. She obtained her Chartered Financial Analyst, CFA, designation in August of 2015 and the Certificate in Investment Performance Measurement, CIPM, credential in November of 2018. She is a member of the CFA Society of the Bahamas and currently serves as secretary for the CFA Society of the Bahamas. Outside of work, Tiffany enjoys traveling, going to the beach, of course, going for walks with her husky puppy. She also likes to give back to the community through her membership with the Rotary Club of East Nassau. And without further ado, I'm going to bring Tiffany on to the stage. Tiffany, thank you so much for joining us tonight. It's really an honor to have someone who is so experienced in the house. And I really wanted to talk about investing because I get a ton of questions from people who are, for lack of a better word, pissed that they cannot access the U.S. market. Mm-hmm. And they want to know, how can I invest? And some people actually don't even try to look for opportunities to invest because they feel stifled that they can't invest in like Acorn or Robinhood or Stash or these You Invest apps, that the U.S. affords. And so I thought it was important for Bahamians to understand that, okay, you may not be able to access the U.S. market in that sense as an individual investor, with the kind of funds that you do have, but there are investment products that you can access in the Bahamas. And who better to bring on than someone who knows all about a series of products for Bahamians?
Good evening. Thanks for having me. And like Sammy said, I'll be speaking about what's available in the local market. I could also touch a bit on what's involved if you did want to invest abroad, if anyone's interested in that as well.
Definitely.
So I just have a bit of a presentation prepared. And I'll share my screen.
And just a little housekeeping, you guys. If you have any questions, feel free to ask your questions. We can see your comments that you leave on YouTube. And so all of that is live. So you can start to let us know that you're here. Let us know that you're excited about tonight, what exactly it is you want to hear tonight or you want to learn tonight. So feel free to drop that in the comments. And here we go.
Okay, so you can see my screen?
Yes.
Okay. So like I said, today I'm just going to speak about managing your personal finances. We already had the introduction, so thanks for that generous introduction. I'll also talk about the importance of saving, investing 101. I'll talk about some solutions that CFAL has, and I'll take any questions. So saving and budgeting. Why is saving and budgeting important? In 2017, Governor John Roll from the central bank revealed that 90% of bank accounts in the Bahamas have $5,000 or less. So that basically indicates that people are living paycheck to paycheck. Unfortunately, as Bahamians, we don't have a culture of saving, and given the current state of the economy and the high unemployment rate, which is estimated at about 40%, it's likely that this statistic has gotten even worse. It's important for us to save for tomorrow and the next month and 10 to 20 years from now. And how do we do this? By minimizing our expenses and our debt, which will allow us to save more. In addition to this, another major reason to save is that we will all eventually stop working. When you get your first job at 21, you think that you have all the time in the world, and then 30 years flies past and you're 50 and nearing retirement. A lot of people end up working for years and don't have a lot to show for it at the end of the day. If you want to live comfortably in retirement, advanced planning is required. We recommend that you start saving for your retirement as soon as you get your first job. In addition, medical advances are causing people to live until 90 or even 100. So if you retire at 60 or 65, you'll basically be in retirement for about 40 years if you live until 100. So could you imagine living until 100 with little to no savings? So that's why it's important to save as much as possible while you're working. Saving, budgeting, and planning will make a reality of enjoying your life in retirement. So money-wise, there's 4 simple keys to a successful savings plan. The first thing that you should do is set a budget. You should also save ambitiously, manage your debt, and give back. So this is a bit of a budget guideline. This is the first key to a successful savings plan. You can tailor this budget guideline to suit you, but it's basically a general recommendation, and it basically outlines how much of your income should go towards your bills, your pension, retirement savings, charity or church, and luxuries. So I'd usually recommend about 60% of your income go towards your bills. That includes your rent or mortgage, which is obviously a large chunk of your income. Going towards that, you have your food, your school fees, your car payments, clothing, et cetera, et cetera. At minimum, 5% of your income should go towards pension and retirement savings. A lot of people don't think about retirement savings, and they don't allocate any of their funds towards their pension and retirement savings. So we recommend at minimum 5% should go towards this. 10% is ideal so that you could live comfortably in retirement. 10% should go towards regular savings. This should be an emergency fund worth 3 to 6 months of living expenses. If COVID-19 has taught us anything, it's that we should prepare for a rainy day. So it is possible that you could lose your job. And now we're saying that your emergency fund may need to be at least a year's worth of living expenses because we have been in this pandemic since March 2020. And now we're in March 2021. And a lot of people still don't have their jobs. So if they would have had an emergency fund and it was only 3 to 6 months worth of living expenses, they would have probably gone through that already. And if they didn't have an emergency fund, they're just having to rely on national insurance. So it's basically very important that you have an emergency fund. Your regular savings can also include other investments, which I'll talk a bit more about later in the presentation. 10% should go towards charity or church if you do tithe. And if you do donate to charity, it's important that you put it in your budget. And 15% should go towards enjoyment and luxuries. That can include your travel, your shopping, your entertainment. But it's important that you ensure that your bills are paid before you take up any enjoyment and luxuries. If you're not paying your rent and your mortgage, you're not paying your BPL bill, you shouldn't be doing a lot of traveling. You shouldn't be wining and dining. You want to make sure that your bills are covered before you do any of this. But now with COVID-19, we're sort of limited in the amount of things that we can do. So a lot of our luxuries have been taken out, and it's allowing people to be able to save a bit more. So saving ambitiously is the second key to a successful savings plan. I already mentioned the emergency fund. You should also save at least 10% of your salary for retirement and other goals. Like I mentioned, save even more if you can. If you can do 15%, if you can do 20% of your salary, the more that you save, the better, and the more comfortable you will be in retirement. Don't wait to start investing. So a lot of people were used to putting their money on a fixed deposit back in the day. So back in the day, you maybe used to get 3, 4, 5% on a fixed deposit. Nowadays, you're lucky if you're getting 0.5%. So you really have to look into other investment options so that you can get a bit more income on your savings. So these investment options can include mutual funds, fixed income securities, equities, and real estate. And I'll talk about all of those, break it down, tell you what they are, and how they work. So why is it important to have an emergency fund? An emergency fund is basically a rainy day fund. It's a fund that you can easily access should an emergency occur, like a hurricane, pandemic, job loss, or medical emergency. So we live in a hurricane zone, and every year we prepare for hurricanes. If a major hurricane hit this year and you experience damage to your home, would you have funds set aside to be able to fix your home? If you had a medical emergency, would you be able to cover the hospital bill? And finally, if you became unemployed, how long would your savings last? So these are some questions that you should ask yourself. And it just demonstrates the importance of having an emergency fund. An emergency fund allows you to be able to bounce back more quickly. You will have funds set aside to pay for unexpected items. It also prevents you from taking on any new debt. So say you had a medical emergency and you went to the hospital, you had to charge your hospital bill to your credit card. Would you be able to pay off that credit card balance pretty quickly, or would you have to carry that balance for a while and pay 18% on that credit card balance? If you have an emergency fund, it would allow you to be able to pay off that credit card balance more quickly, and you wouldn't take on any unnecessary loans. It also provides peace of mind. Things happen, you should ensure that you are prepared. If you are currently employed, you should save aggressively towards an emergency fund, because you never know if you can lose a job or experience a pay cut in the future. Nobody's job is guaranteed. So debt management is the third key to a successful savings plan. Unfortunately, the individual debt levels in our country are very high. People tend to get loans for everything from furniture to vacation to school fees, rather than saving up for a purchase. It's important that you minimize your debt so that you can increase the amount that you save. If you are overburdened with debt, should you invest or reduce your debt? Typically, you should reduce your debt because the rate on debt is pretty high. So typically, credit card debt is 18 to 22%. Consumer loans can range from 6 to say 12, 15%. So if you're investing in something that's only making say 5 or 6%, you should try to reduce your debt as much as possible first, and then you should invest. Pay off your higher interest rate loans first. So that's like your credit cards, your consumer loans, and then your lower interest rate loans, which would be something like a mortgage. A lot of the banks try to encourage you to consolidate your debt. When it comes to debt consolidation, it's important that you look at the terms of the loan. Make sure that the debt is not being extended too far into the future, because in the end, you could end up spending even more. So make sure that you look at that before you consider debt consolidation. And then the fourth key to a successful savings plan is to give back. Currently, we get a lot of questions if people should give back because they're currently struggling with their current economic situation. You may find it hard to give to charity or to be able to tithe at this current time. So obviously, we would recommend that you take care of yourself first, and then once you get yourself on stable footing, then you can look at your giving back. But who should you give to? Give to something that you're passionate about, whether it's your church, Cancer Society, the Humane Society, AIDS Foundation, or anything like that. Make sure that it's something that you're passionate about when it comes to giving back. And also make sure that you include it in your budget. Okay, so when it comes to investing, there's 5 starting principles when it comes to investing. The first thing that you should do is invest for the long term. A lot of people want to get rich quick. They don't like slow and steady returns. But savings and compound interest takes time to show benefits. And if you have patience, you'll definitely be rewarded. The second thing you should do is choose an investment strategy. So ask yourself if you like low risk investments or are you more of a risk taker? What level of risk will allow you to be able to sleep at night? The third thing you should do is diversify. So don't have all of your money in one place or don't have all of your eggs in one basket. Try to diversify your money across a variety of different types of investments, a variety of different companies, a variety of different asset classes. Diversification is very, very important when it comes to investing. Fourth, know the charges and fees associated with your investment. Are you paying out more than you're making? So you may have an investment account, but the fees on that account are extremely high. You may be invested in a mutual fund, and the fees on that are very high, and it just doesn't make sense in the end. So make sure that you know the charges and fees associated with any investment before you get into it. And then finally, review your investments on an annual basis. Things can change from year to year. So if you compare 2020 to 2019, obviously things have shifted dramatically. So it's important that you would have reviewed your investments in 2020. Some things can happen in your life. You may have a child. You might want to start a college savings fund. You might want to start a retirement plan. You might have gotten a raise. You might have gotten a bonus. So you may be able to change the amount that you're able to save. So it's important that you review your investments on an annual basis. Okay, so risk tolerance is very important when it comes to investing. Determining your risk tolerance is the first step to take before choosing the best investments for your financial goals. Risk tolerance is a degree to which you are comfortable with volatility or variability in investment returns. So just basically, how comfortable are you with fluctuations in return? How do you feel about negative returns? Do you not want to lose any money at all? Just ask yourself, how much risk can you tolerate before you make an investment? There's several things that affect your tolerance for risk, one of them being your investment time horizon. So do you have a short-term time horizon or a long-term time horizon? If you're retiring in 5 years, you typically have a lower risk tolerance. You can't withstand any fluctuations. You typically wouldn't be able to invest in some risky company that could possibly go belly up and you lose all of your retirement savings. Whereas if you are further away from retirement, say you have 30 years until you retire, you can withstand a bit more fluctuation. You can withstand some negative returns. So you have a higher tolerance for risk. Also, another thing that affects your risk tolerance is your investment return expectations. If you want to make a higher return, you typically have to take a bit more risk. Some people are not comfortable with this, so they'll just have to settle with a bit of lower returns. And then finally, your additional sources of potential income. So do you have additional sources of retirement income? If your pension plan is your only source of income in retirement, so you don't have any other investments, any other savings, you typically can't take a lot of risk with your pension plan, and you should invest in something that's a bit more conservative. Okay, so this pyramid basically shows you the relationship between risk and return. And it just shows that for lower return, you typically have lower risk. If you want to achieve higher returns, you typically have to take on a bit more risk. So at the low end of the pyramid, you have your checking and savings accounts. Your checking and savings accounts are basically paying you little to nothing nowadays. I think savings account is giving 0.03%. And by the time you take out your fees and everything, that's probably negative. A term deposit, you're lucky if you're getting 0.5% nowadays, like I mentioned. But there's other investments that have a bit more risk that are still, it's still pretty conservative. Something like a bond a corporate bond, a government bond. So it's a bit more risk than, say, a checking or savings account, but it's still pretty low risk. And you get, say, high end of the pyramid, you have your equities. So when you buy an equity, it's a stock, and you could lose all or most of your investment. You could have negative returns. So you would have to be able to withstand fluctuations in return. If you invest in a startup company, there's a possibility that you could lose all of your investment, and there's a possibility that you could make a lot of money. Okay, so this basically shows you the types of investment vehicles that are available. Starting with cash, I already mentioned your savings accounts and your fixed deposits are paying you pretty low rates nowadays. They're pretty low risk. But then you also have money market funds, which provide you with a bit of a higher return. They're typically invested in short-term government bonds and term deposits. So it's a way to get a bit of a higher return than what you would get on a savings and a fixed deposit. And it's pretty easy to get out in and out of a money market fund because they're typically daily or weekly funds. Then you have fixed income. And fixed income is a debt obligation to the government or a company which pays interest. So a lot of people have been participating in government bonds nowadays, trying to get a bit more return on their investments. So the government has basically been coming out with government bonds on a monthly basis. So if you look out for them, they usually come out around the middle of the month. And they have varying levels of maturity and varying rates. Then you have corporate bonds. So a corporate bond is basically a loan to a company, whereas a government bond is a loan to the government. And in return, you get interest paid usually twice a year. And once the bond matures, you get all of your money back. I mentioned equities. We do have a local stock market in the Bahamas. It's called BISX, and it only has 20 listed stocks, but it is available. If you did want to invest internationally, you would have to apply to the central bank to purchase those shares or whatever security it is. You would have to apply to the central bank for the investment currency market, and then you would send those funds through the central bank, and you'd have to pay a 5% premium on wiring the funds, and when you bring it back, you get back 2.5%. So when you sell, you get back 2.5%. So you net 2.5%. So that's if you wanted to invest in any international companies like your Microsoft, your Apple, your Home Depot, anything like that. You would just apply to the central bank and say that you want to purchase a certain amount of shares, the amount that you wish to invest. Now, currently, the investment currency market program has been suspended. This stopped, I think, last year, March. Currently, it's still suspended, but hopefully once tourists come back into the country and we get some US dollars coming back in, the central bank will start granting approvals again. So they basically want to minimize the amount of the US dollars going out of the country. So that's why they would have suspended the program. But there is a way that you can invest abroad if you wanted to. And the rate on that has gone down significantly. So in the past, you had to pay the central bank 13%, and you were wiring out the funds and when you were making the purchase. But now it's only 5%, so it's a little bit more affordable. So then you have mutual funds. I'll go over the mutual funds that CFAL has available. But a mutual fund offers you diversification, and there's various strategies for mutual funds. And then real estate is popular in our local market. So a lot of people buy houses and maybe downsize when they retire. and then live off of the money that they made on their house, or they may buy a duplex or a triplex and be able to live off of the rental income in retirement. So that's a good way to invest as well. Okay, so I'm going to specifically talk about bonds, equities, and mutual funds because they're the most popular investments that we have in the local market. So I already mentioned a bond is a fixed income instrument that represents a loan made by an investor to a borrower. And you can make this loan to a company or the government. They can have a variety of interest rates and maturities. A corporate bond usually has a higher rate than a government bond. So if you lend money to a company, it's typically a higher risk than if you lend money to the government, because a government bond is supposed to be government guaranteed. So it's more likely that you'll get your money back than if you lend money to a company. So in order to compensate the investor for the level of risk, a corporate bond would have a higher rate. And the same applies for bonds with longer maturities. So say I buy a bond, or I lend someone money, or I lend a company money for 10 years versus a bond that is 20 years. So basically that company is holding that money for a longer period of time. So you need to be compensated for the level of risk because they're holding that money for a longer period of time. So it's less likely that you might get your money, but if they are able to pay you back, you want to be able to be compensated for it. The pros of investing in bonds are that it's a contractual payment of interest and principal, a relatively safe investment, and lower volatility than other asset classes like equities or derivatives or any currency or anything like that. The cons are bonds are usually long-term investments. So like the government bonds, they can go up to 30 years. So that's a very long-term investment. And there is a possibility that an issuer may default on a loan. And then you have stocks. So a stock is a share in the ownership of a company. Stockholders have a claim on the company's assets and earnings. So in our local stock market, you have the Commonwealth Bank, your Cable Bahamas, your Court Development, J.S. Johnson, shares like that. So if you buy one of those stocks, you can buy one of those stocks on BISX, and basically you have ownership in that company when you buy those shares. So the pros of buying a stock are there's potential for high returns via price appreciation. So there's a possibility that the price can increase in the shares. Equities have typically outperformed most other investments over the long run. Some stocks receive the share of company profits via dividend payments. In our local market, everyone likes the dividends. If a company doesn't pay a dividend, basically nobody wants it. So just look at the dividends if you are interested in purchasing the shares. Ensure that they're consistent with their dividends. Look at their financials before you make any purchases. You also get voting rights in the company if you buy a stock. Some cons of investing in stocks are that stock prices can be very volatile. So there is the potential to lose all or most of your investment. The income is not guaranteed, so the company does not have to pay you a dividend. And if you lose all of your money, there's no guarantee that you're gonna be able to sell it. It might be worth zero eventually. So income is not guaranteed. And you're also paid after creditors, bondholders, and preferred shareholders in the event that the company liquidates. And then you have mutual funds. So this is a financial vehicle made up of a pool of money collected from many investors to invest in securities like stocks, bonds, money market instruments, and other assets. So locally, there are several companies that provide mutual funds, and you can invest with several companies. I work for CFAL, and we do offer mutual funds, which I'll go over in a bit. But when you do, when you are looking at investment options, shop around, ask questions, ask if there's any subscription fees to invest in this mutual fund. What are the fees like? Can I withdraw? Just shop around and make sure you find out what all of your options are. The pros of investing in a mutual fund is that they are managed professionally by an investment manager. So you'll have someone that would manage the money that's coming in. They'll make certain purchases to try to get the most return on the investment for the people that are subscribed to the fund. And they also provide diversification. So usually when you buy stocks, you typically have to pay commission fees, business fees, and it can be pretty expensive. But if you invest in a mutual fund, you can have exposure to a variety of securities without having to purchase them individually and not having to pay those high costs. So you have exposure to a variety of securities, industries, and companies all in one mutual fund. Usually they're low costs, and a lot of the local mutual funds have a low minimum investment, and it's pretty affordable. Whereas if you buy, say, a minimum initial investment, company. But if you're in a mutual fund, you're not directly able to company affairs. Sometimes some mutual funds can have high expense ratios. They can have high investment management fees, and they can have high subscription and redemption fees. So it's important that you do your research, like I mentioned. Okay, so I'm going to tell you a bit about the investment products that CFAL has. And CFAL is a leading independent investment and advisory firm and the largest pension provider in the Bahamas, with a proven record of financial stability and integrity in all economic climates. So CFAL has been around since 1997. So we've been around quite a while. Withstood the financial crisis in 2008. And been around for over 20 years. We currently have assets under management of 1.9 billion. We pride ourselves on segregation of assets. So we keep the assets of the company separate and apart from the assets of the client. And that is very important because should something happen to CFAL, your assets would be protected because they're held separately in a separate registration. We provide both international funds. So we have 3 B-dollar funds and 2 US dollar funds. So you can invest internationally through our international mutual funds. That has actually also been suspended, similar to the investment currency market program with the central bank. So hopefully, once the ICM program resumes, the unsponsored BDR program will also resume. So if you invest in our international funds, you only have to pay a stamp tax and conversion of 1.75% compared to the investment currency market's 5%. That's a good way to get exposure to the international market. So that's our global equity and our global bond fund. We are regulated by the Securities Commission of the Bahamas and the U.S. Securities Exchange Commission. We are also the largest provider of individual and group pensions. So we have individual plans and we also have group pension plans. We were named Pension Administration Company of the Year in 2012 to 2016 by Corporate International, and we're also named Best Investment Management and Advisory Firm in 2018 and 2020 by Acquisition International. So some of our investment solutions include the CFAL family of funds, which is our most popular investment option, the CFAL Savings Express, the CFAL Advantage College Savings Plan, the CFAL Blue Marlin Retirement Plan, and the CFAL Private Wealth Account. Okay, so starting off with our CFAL family of funds, these are tailored solutions that can help you achieve your financial goals. Some of the benefits of our family of funds are that we have a diverse range of investment objectives suitable for all investors. So we have very conservative funds, so very low risk, And then we have funds with a bit of a moderate risk level. And then we have high risk levels like our CFAL Global Equity Fund. So that's our most aggressive fund. They're affordable. We do not charge subscription or redemption fees. And we also have low management fees and strong performance. So our funds offer returns highly competitive in the domestic capital markets. So I mentioned we have 3 B dollar funds, 2 US dollar funds. Our B dollar funds are monthly and our US dollar funds are quarterly. So if you want to subscribe to the fund, you can do that on a monthly basis. You can deposit to the funds monthly. You can also withdraw on a monthly basis. You would just have to wait 10 to 15 business days after month end to receive your payment. The minimum initial subscription for our B dollar funds is $1,000. So it's pretty affordable. Like I mentioned, our US dollar funds start at $5,000 plus the 1.75% stamp tax and conversion, like I mentioned. The minimum additional subscription for the B dollar funds is only $100, and US dollars is $1,000 plus the stamp tax and conversion. And all of our funds have free online access, and you get quarterly performance reports from us. Okay, so I'll only be talking about the B dollar funds today, just because the unsponsored BDR program has been suspended for now. But you can find the returns for our international funds on our website at cfal.com/mutual funds. So our bond fund is the most popular fund at CFAL. It has assets under management of $299.175 million. This fund is invested in government bonds, corporate bonds, term deposits, so very low risk investments. I already mentioned bonds typically have low volatility. So most Bahamians choose this fund because they don't want any fluctuation. They don't want to see any negatives on their statement. So the return last year was 4.55%. In 2019, the return was 3.73%, and 2018, 3.97%. Annualized return since inception is 5.15%. And then we have our balance fund. So the balance fund is invested in the local stock market. So if you were to choose this fund, you would have to make sure that you're comfortable with fluctuations. So sometimes there could be a month where you have negative returns. There could be a month where you have positive returns. So that is just something to be aware of. We usually tell most of our clients to take a risk profile test just to see what your comfort level is with risk. And then it would help you select one of the funds. This fund is much smaller at $18.985 million, just because people don't like the fluctuations. And you can see last year's return was pretty low at 1.58%. The year before that, 2.93 and 2.49. So the local stock market was down about 6% last year, and then that affected the returns for the balance fund. Our next B dollar fund is the CFAL Money Market Fund. This has assets under management of $24.25 million. The return on that is 2.6% last year. So this is invested in government bonds and term deposits. So I mentioned if you invest in a money market, it's pretty safe investments and it's pretty easy to get out of. So this fund is weekly, and this is a good option for an emergency fund. So say you had an emergency, you'd be able to withdraw the funds in the following week. So that's something to consider. And most of the local broker dealers have similar strategies. So they'll have a conservative fund, a balanced fund, a very low risk fund. So just shop around, find out what's out there, what type of mutual funds are out there. It's a good affordable way to save your money and be able to get a higher return than what you would get at the bank. So then we have the CFAL Savings Express. So if you cannot afford the $1,000 initial investment for our B dollar funds, our mutual funds, we have something for everybody. This starts at only $100. So it should be pretty easy to come up with $100. And then additional contributions are as low as $25. So you could maybe save $5. Don't get a $15 lunch every day this week. Maybe get a $10 lunch, and then you'll be able to save up for your monthly contribution. You could also do automatic debit or salary deduction if you want. So we bank with First Caribbean, and you can have the money automatically go there. That's an easy way to force yourself to save. So if you set up a salary deduction, the money is automatically going into the savings product, and you don't have to worry about it. With the Savings Express, you're not allowed to withdraw in the first 2 years, and after that, you're allowed to withdraw twice per year. A lot of people use this, say if they want to save up for a down payment, or if they want to buy a car, or if they want to save up for school fees, things like that. So it's a good way to get in the habit of saving, even if you're only starting off with a small amount. And with this, you get online access. And then we have the CFL Advantage College Savings Plan. If anyone has kids or grandkids, it is a good way to start saving for your child's college education or your grandchild's college education, if you're a really generous grandparent. The earlier you start saving for your child's college education, the better. Tuition rates typically increase at about twice the general inflation rate. On average, tuition tends to increase about 8% per year. That means that the cost of college doubles every 9 years. For a baby born today, that means that college costs will be more than 3 times the current rate by the time the child has to go to college. So that basically demonstrates the necessity to start saving as early as possible. You can come into our office and let us know how much you want to have by the time your child or grandchild goes to college, and we can provide you with a projection of how much you need to deposit per month. So if you look at this slide, if you were to contribute $100 per month for 6 years, so you started pretty late, you would save about $8,644. Whereas if you save on the high end at $500 per month for 18 years, you would save about $170,786. That's assuming a rate of 4.75%. So it just shows that the more you put in, the more you get out, and the earlier you start, the better. We also have a Blue Marlin retirement plan. So most local broker-dealers have retirement plans, individual retirement options. Our retirement plan is pretty affordable, starts at a low initial deposit of $50 and minimum additional investments of $50 per month. And you would choose one of the CFAL funds. Most of our products are tied to one of the CFAL funds. The Savings Express is tied to our CFAL money market. So the return that you would get in the CFAL money market is the return that you would get in the Savings Express. The Advantage, you would choose any one of the funds. So bond fund, balance fund, whichever one you prefer. Blue Marlin, you would choose one of the funds as well. So you would get the same return as what you would get if you went directly into the fund. Now, the Blue Marlin is locked in until retirement. So it's supposed to be considered a pension plan, and you can't withdraw from it until you retire. So if you want the option to be able to withdraw, we would usually recommend you go directly into one of the mutual funds. And then our final product is our private wealth services account. This is basically a holding account for all of your investments. If you have any shares currently, say you have some Commonwealth Bank stock or you have some bonds, typically you would hold them in your own name. Whereas if you buy them in a brokerage account, you have all of your investments in one place and you're able to see it all in one statement, and you're able to keep better track of your dividends and your interest. The minimum deposit for our private wealth services accounts is $50,000 in cash or securities, and the cost is $350 per year or $87.50 per quarter. So there's a few benefits to having a private wealth services account. You're assigned a client relationship officer. So if you make any deposits or any withdrawals, you will contact that client relationship officer, and it's basically a more personalized service. We offer custody, advisory, and discretionary accounts. So a custody account, you would basically instruct on all of your investments. If you have an advisory account, we would make recommendations to you on things that we think that you should purchase based on your risk tolerance. And then we have discretionary accounts where we would set up an agreement based on your risk tolerance, saying you want this amount of stocks in your portfolio, you want this amount of bonds, and we would basically be able to invest on your behalf. We do offer local and international private wealth accounts. You also have the option to get online access. Another major benefit is that you have reduced costs and paperwork on trades. So if you buy shares yourself and you don't have a private wealth account, typically the fees are much higher than if you did have a private wealth account. Another major benefit is you are notified of public and private offerings. So if there is a local stock offering, you would hear from us and say, are you interested for your account? If there's a private offering, a lot of times nobody hears about it. So it might be offered in-house or not offered to the wider public. But if you have a private wealth account, you would hear about it. You also have an automatic sweep of income into the CFAL funds. So if you have government bonds currently, usually your interest goes to your bank account, and you're likely to spend that money if it hits your bank account. Whereas if it hits your private wealth account, we can move that money into one of the funds, so you're gaining interest upon interest. And then we also offer financial and retirement planning. So we offer budgeting to our clients. If you have a goal, you want to have this amount by the time you retire, we can sit with you and let you know how much you need to deposit into your account so that you can meet your goals. So wrapping it up, there's a few things that I would like you to keep in mind. The first thing you should do is assess your current financial situation. So look at your budget, determine what your income is, what your expenses are, what your debt levels are, and figure out what needs to change and how you can be able to save more. Update your budget regularly, monthly if you can, quarterly if you can, at minimum once a year. So usually in January, I try to update my budget, look at what my income is, what my expenses are for the year, and make any changes if necessary. Cut out non-essential spending, reduce your expenses. The more you cut out your non-essential spending, the more that you can save. Also, if you haven't already, please set up an emergency fund. COVID has taught us that it is important to have in the event you lose your job, you have a medical emergency, the fund is there and you can rely on it if something does happen. Before you invest, educate yourself. So I mentioned shop around, find out what options are available to you. Look at this credit union, look at this broker dealer, look at the stocks that are out there, look at all the investment products. So basically just educate yourself. If you need to ask questions, make sure you do that. And finally, start to build an investment portfolio if you don't have one already. Look out stocks, bonds, and definitely invest according to your risk tolerance. Consult a financial advisor if you need help. This is very, very important. If you're overwhelmed, if you're confused, you don't know where to begin, you can consult a financial advisor. You can consult a financial advisor to look at your budget if you need to figure out what you need to cut back on so that you can be able to save. And if you have any questions about any investment products, a financial advisor can do that for you. So I want to thank you so much for your attention. If there are any questions, I guess I can take them now.
Awesome. Thank
Thank
you.
you.
Oh, is there echo? Okay.
Right.
So, so he would have gone through all of the different products, Bahamas, non-Bahama, US, etc.
Mhm.
And okay, so if I am a person, say I am 26, and I am lost, and everyone is telling me go buy a triplex. That's the only investment product you need. Build a duplex or whatever. What do you tell that person in terms of setting themselves up for the long term from an investment perspective?
Um, I would say that you should diversify, like I mentioned. So property should not be the only thing that you invest in, because property tends to be a very large investment.
Mm-hmm.
So you have to usually come up with a large down payment if you are going to the bank to get a loan. And there's a lot to come up with. Building is very expensive in this country. Sometimes start small. Yes, you might want to start off with that duplex or triplex, and it is a good form of income. So I would say work towards that, but also start with something small, like a mutual fund or a savings plan or something like that.
And if I wanted to talk to a financial advisor, that's just a phone call to C-File to say, can I meet with someone?
Yes. Mm-hmm.
Okay. And then my final question, I don't know if we have any questions from the audience, is I'm not sure if you know, but the process of investing in government bonds directly with the central bank, when they would issue that thing in the newspaper, what do I do if I want to take advantage of that?
Yeah, so you can go on their website and download the forms. And typically, they're doing everything virtually now. They don't want people coming into the office. So you would basically just fill out the form, email it to them. All of the instructions are on the website. And then usually you would just transfer the funds along with a copy of your passport. I think it might be 2 forms of identification. But if you go on their website, it gives you all of the instructions on how you could purchase government bonds. And they're basically in the paper monthly, and then they post them on their website every month as well.
Awesome. We do have a comment here. Lakeisha says, great information, Tiffany. So
Thanks,
again,
Lakeisha.
I am so appreciative of you sharing this wealth of knowledge with us. I hope people understand that they can start small. I love that you showed the difference in if I start saving for my child's college tuition now versus 6 years before they have to go off to school. So don't say, okay, my child is in high school now. Let me, save
Yeah.
$100 a month. Start as soon as they're born, saving up. And even if it doesn't cover the full expense of university, at least you would have taken a huge burden off of that child. And then that's investing in your legacy. And so thank you so much. I don't know if you have any parting words for people to shift their mindset to be investors.
Well, just thank you for having me. And I think COVID has definitely spurred we have a lot of people coming into our office and trying to start saving, trying to start that emergency fund. Unfortunately, it brought something like this pandemic to force people to try to save, but it's never too late to start. And there's lots of investment products out there. There's lots of knowledge on the internet or the resources on the internet if you need to find out more about investing. It's important to get started and not wait until, say, you're 5 years away from retirement and don't have anything saved. So just make sure that you try to get your finances in order as much as possible and look into those investment options because it will definitely help you in the future.
Awesome. Thank you. And if you do go to C-File, if you do meet Tiffany, let them know that you are there because you saw the Wife Her video. So again, thank you all so much for joining. If you're watching the replay, thank you so much. Leave a comment for us. And we will see you on Sunday when we talk about wise borrowing. Have a great night. Bye.
Good night. All right.